Okay, today we are going to start the new topic is a foreign currency revaluation. Okay, so foreign currency revaluation. So for what purpose we need to we need to perform this activity? Okay, so the foreign currency revaluation, okay, as you remember, as you aware, every day, every minute, every second the exchange rate fluctuations, okay, it is going to happen. Okay, now let me show you what is the current exchange rate which is available from USD to INR. Okay, then let me show you one small example. If I come down here, you can see the USD, US dollar, 1 US dollar into INR, Indian rupees, 1 US dollar is equal to now 81.9075. This is the current rate. Okay, once the market will started, okay, at 9:15 or 9:30, okay, then again it will get change. It will get change in the sense maybe it will go up, it will go down. Okay, so due to this fact, we must have to perform the foreign currency revaluation. Due to the exchange rate fluctuations, we must have to perform the foreign currency revaluation. Okay, so this is the reason behind that to perform the foreign currency revaluation. Okay, I will explain you the one by one. Okay, remember the FC revaluation we can perform. We can perform only on foreign business transactions, either it's a whatever it may be. Okay, the basic fundamental thing is that the foreign currency revaluation we can perform only on foreign currency, only on foreign business transactions. Means the currency, now we are in India, whatever the business transaction which are posted in INR, means we with Indian rupees, for them the foreign currency revaluation will not be applied. Only the transactions which we are posted into other than local currency, other than Indian rupees, okay, on that transactions only we need to calculate the, or we need to run the foreign currency revaluation. Okay, this is the reason behind that. Okay, why we need to run the foreign currency revaluation? Due to the exchange rate fluctuations. Okay, so then then one more thing, the foreign currency revaluation note, the FC revaluation, the FC revaluation can perform on, okay, GL, general ledger accounting, accounts payable, and accounts receivable. Okay, these are the, on these modules, the FC revaluation which we are going to perform in real time. Okay, so if let us talk about the general ledger accounting, for what kind of transactions we'll have in general ledger accounting to perform the foreign currency revaluation. Okay, so let us assume we borrowed loan from outside of India, means we borrowed loan from, let us assume, from Singapore. Okay, at this point of time we must have to make the payment interest during the month end, okay, into the Singapore dollars in the form of their local currency. So at this point of time we must have to perform the, okay, maybe we have agreed 5%, okay, every month, monthly, bi-monthly interest 5% we have agreed, but the whatever are 50 or 500 US, 500 Singapore dollars, we have to make the payment as a in the form of EMI. Okay, the 500 USD is the same. Okay, Singapore dollars is the same, but due to the exchange rate fluctuations, we must have to make the payment either higher amount or lower amount. That I will show you. Okay, that is the part of GL accounting. Then accounts payable. Okay, in real time, most are the cases, the issues, okay, will come from the business, from the accounts payable point of view only, because accounts payable, when we do the payment, it is going to have impact on our books of accounts, our financial books of accounts. So that is the reason more and more concerns will come from the business, from the accounts payable point of view. Okay, I will explain you one by one, the step by step. Then accounts receivable also, when we receive payment from the customer, either it's a profit or loss, okay, it's a customer point of view. Okay, when if we want to think about customer point of view also, then we can run the foreign currency revaluation for accounts payable, accounts receivable also. But most are the cases in real time, the accounts payable and GL. If it is a foreign loans are available, then we can have a foreign currency valuation on GL accounting. Now, in this foreign currency revaluation, we have the concepts. Two concepts are there. One is unrealized, another one is realized. We must have to understand. One is the concept. Either it's a exchange or loss, whatever it may be. First, let us understand the what is realized, what is unrealized. First, we will discuss about unrealized. Okay, then realized. Realized. What is the difference between unrealized and realized? Okay, unrealized in the sense, the payment, the payment not yet made, but as part of month end, as part of month end, know we need to know whether we are in profit or loss due to exchange rate, due to exchange rate changes on business transactions. Meaning here is that, means the payment, means we have not, suppose let us assume I have posted one document into the system on 1st of September. Okay, so in that document, what I have given the terms of payment is a net 45 days. The meaning here is that, means I will do the payment. Okay, means after 45 days only. Okay, I am going to make payment to that vendor after 45 days. Means if I post the document 1st of September, that will be due, that will become due in the month of October 15th. Okay, so until 15th of October, I am not going to make the payment. Now, if I am going to calculate month end revaluation, I am performing month end revaluation as part of September month end. Then I want to know whether the posted transaction exchange rate changes. Okay, so whether my whether because of that particular business transaction, whether I am gaining or losing due to the exchange rate fluctuations. Then realized means, once we do the payment, once we do the, means at this point of time when we will be there into realize unrealized, means I don't know. Okay, but only because of exchange rate fluctuation I came to know it's unrealized, means I have not yet made payment to the vendor. How much I am going to lose, a loss, and how much gain I am going to gain. Okay, I don't know at that moment. Okay, that is the reason unrealized, we could say, is a unrealized. Then unrealized also, it's unrealized gain is there, unrealized loss is there. Okay, I will explain you in detail. Okay, with example, with the real time example I will give. Then realized. Realized means once we do the payment, once we do the payment to vendor, okay, what will happen? Now I'm doing the payment completely 15th of October. Okay, then what will happen? I will come to know exactly how much amount I am going to loss or profit. Okay, that we can say is a okay. Once we do the payment to the vendor, okay, then we will come to know. Then we will come to know profit, realized profit or loss. Okay, I will explain you with example. First we need to understand unrealized and realized. Okay, I will take a small example, then with that we can able to understand easy. Okay, if you understood this concept what I'm going to explain, then it will be easy for you to join now. Then it will be easy for you to okay to understand. Okay, now I will take the first of all we'll discuss about the concept. Sorry, unrealized loss. First we'll discuss about the unrealized loss, how we are going to calculate the unrealized loss. Okay, now this is the remember this concept is for very important for your interview point of view also. Even in the interview also, in the interview you must have to explain okay unrealized gain, unrealized loss, realized gain, realized loss. Okay, along with this concept you must have to explain accounting entries also in the interview, remember. Then I will give the example. Okay, we'll go for the for unrealized loss the example now. 1st September 2022. Okay, I have purchased. Pur- Hello. Okay, fine. So I have done purchased. Then currency, currency, Singapore dollars. Okay, currency is a Singapore dollars means which I have purchased is the okay Singapore dollars or USD, whatever it may be. Let us assume. Okay, let us assume USD. Okay, okay, Singapore dollars. I will assume Singapore dollars. Okay, I will let you know what is the Singapore dollars. Now, 1st of September. Okay, I have purchased one business. I mean, I have done some purchases from this Singapore. Then the the Singapore currency, how many Singapore dollars? Okay, the worth of the purchases is a okay 1,000 Singapore dollars. Then the exchange rate. What was the exchange rate? Exchange rate on 1st of September. Okay, so exchange rate was there on 58 rupees, means 1 Singapore dollar is equal to 58 Indian rupees. Then Indian rupees, if I convert this one into INR Indian rupees, what is going to happen? 1,000 into 58, 58,000. Okay, 58,000 rupees which I want to make payment to the vendor. Okay, because I have done the purchases. Then in this only the net due date, net due date what I have given is a 45 days. 45 days means when the net due date, the due date will be a okay the due date okay as per the terms of payment, the due date will be a 15th of October, 15th of October 2022. This is the due date for payment, due date for payment. Okay, so 15th of October will become the line item will become due to make the payment. Then you just forget about the due date. Okay, I just have given. Now 30th month end, 30th of September 2022. Okay, the same thousand, the same Singapore dollars 1,000 only it is there, but here the exchange rate got increased, it means from 58 to it gone 59. Okay, it gone 59. Then thousands, the Singapore dollars means it's 1,000 only, but the exchange rate it has got increased. Now you can see, now during the month end what we need to do. Okay, now as part of exchange rate fluctuations, now we could see is a 59,000 rupees, but only in when we purchased at that point of time we only have the 58,000. Now it is a 50 9,000. Then purchase value minus month end exchange rate means the 1,000 rupees, it is the loss for us. Means because of the exchange rate increased, go up, the exchange rate has gone up, so that is the reason we must have to, okay, bear this loss. But this loss we have to show in our books of accounts into P&L account. But remember one more thing, this is a unrealized, this is a unrealized, this is a unrealized loss. What we could say, it's a unrealized loss. Okay, means due to the fluctuation, means in the month end 30th of September, as part of foreign currency revaluation, because the foreign currency revaluation is a month end activity, every month we must have to perform. Okay, in the month end I came to know this is the unrealized loss. Okay, but only this is the unrealized, this is my assumption only. But originally when I am going, when I will come to know, when I will make the payment 15th of October, maybe at that point of time my exchange rate maybe goes down. Okay, at that point of time maybe I will come to know what is the exactly, okay, the loss or gain which I am going to, which I am going to bear. Okay, so this is the concept of unrealized loss. Okay, unrealized loss, it is a because of the exchange rate fluctuations. then then the next one is the accounting entry, also very very important one. Even for this one, what is the accounting entry? What is the accounting entry for the, when we are going to, okay, the for unrealized gain, oh, sorry, for unrealized loss. If it is an unrealized loss, the accounting entry as follow. Then accounting entry is a thing. Then unrealized unrealized loss account is going to debit. Then to balance sheet adjustment account, balance sheet adjustment account, balance sheet adjustment account is going to credit. So this is the accounting entry what we can see. Okay, this is the accounting entry. Okay, remember accounting entry is also very very important one, even for interview point of view also the accounting entry also important. Okay, unrealized loss account, it is going to debit. To balance sheet adjustment account, it is going to credit. Okay, this is the important for us. Okay, I'll keep it in between only. Okay, now the next one is the realized loss. Sorry, unrealized loss. Then unrealized gain. Okay, real unrealized loss we have already discussed. Then unrealized gain. Okay, what is the unrealized gain? How it is going to impact? Now I'll take the same example. Then unrealized gain. Okay, now what is going to happen here is the, now when I purchased, okay, when I have performed the business transaction, the exchange rate was 58 rupees. Okay, now let us assume the same net due date is a 45 days. The due date, the line item will become due in the month in 15th of October. Then on 30th of September, when I am performing the foreign currency revaluation, maybe my exchange rate gone is a 57. Now you can see, now it's a, during the month end my exchange rate is a 57 only, but when I did purchases at that point of time 58 my exchange rate was. Now 1,000 rupees is means, see, purchase at the time of purchase the total INR 58,000. Now during the month end only 57,000, means 1,000 rupees I am going to gain. This one unrealized, what I could say, this is the one this is the one is the unrealized gain. Unrealized gain. Okay, so unrealized gain this week, because we are gaining the month end exchange rate. Okay, month end India exchange rate and as well as at the time of purchase rate, the both are the exchange rate is different, because here the exchange rate, okay, fluctuation, it's gone, okay, it's down. Okay, so here the accounting entry is a balance sheet adjustment account is going to debit. Then unrealized gain account is going to credit. Okay, this is the accounting entry. Remember, accounting entry is also very important one. Okay, if anyone is not understanding, please raise your hand so that I will clarify once again. Okay, but you need to understand clearly. Okay, now this is the concept of unrealized, because here I don't know. Okay, only this is my assumption only, but when I am going to make the payment, then only I will come to know whether it is a profit or loss. Okay, now then I'll take the same example. Then the scenario number 3. Scenario number 3 is the realized loss. Okay, it's not the unrealized. Okay, realized loss. Okay, now here you just forget about the month end. Okay, now the concept, now the due date will come into the picture when we are going to perform the realized. Okay, now 1st of September, okay, we have purchased 58. Okay, this is the month end. Okay, then when I am going to make the payment, okay, on 15th of October 2022, I am making the payment to the vendor. Okay, payment I am making payment. Then currency the same, Singapore dollar, same 1000 USD, 1000 Singapore dollars only, but when I am making payment in the month of October 15th, okay, what is my exchange rate? My exchange rate here, you just assume, okay, realize a loss. Okay, my exchange rate, it gone is a 60 rupees, means it has got increased, but which the exchange, the Singapore dollar, 1000 Singapore dollars only, but the making, when I am making payment here, now you can see this and this. Now 60,000, the purchase price, there is a difference between purchase price and payment price. Okay, what is the difference between purchase price and payment price? Now so 2000 is the, this is the realized loss. Now this I could say realized loss, means in the month end I don't know. Okay, when I perform month end revaluation, but on 15th of October, as soon as I performed the, okay, revalue, as soon as I do the payment to the vendor, then I will come to know realized loss, means this is the, instead of, because when I purchased, I should suppose to make the payment only 58,000. But now, due to the exchange rate fluctuations, I must have to make payment, instead of 58,000 rupees, I have to make payment 60,000 rupees. So the exchange rate, it gone high. Okay, so that is the reason I have to bear extra 2000 rupees while making payment to the vendor. This is the realized loss. This we could say is the, okay, the realized loss. This is the scenario number 3. Remember, scenario, this is the, okay, the scenario number 3. If it is a realized loss, okay, how the accounting entry it is going to hit. Then, okay, realized loss account is going to debit. Realized loss account is going to debit. Then vendor account, is going to debit. Then to bank account, credit. So this will be the accounting entry. Okay, accounting entry for the realized loss. Okay, this is the accounting entry. Then Then we'll take for the okay. Then I'll take the realized gain. Realized gain. What is the concept of realized gain? Then the realized gain, suppose let us assume, let us talk the same example. Okay, now 1st of September we made the purchases, then 15th the same due date is the okay due date for the payment is the 15th of October. When I am doing payment to the vendor, okay, my exchange rate it gone. Let us assume is a 56 rupees. 56 rupees means okay, I'll take the 56.5. Okay, now see due to the I mean the purchase exchange rate is a 58, but the payment exchange rate is a 56.5. Means when I purchased, I have to make the payment 58,000 rupees, but due to the exchange rate fluctuations the exchange rate has gone okay down, so that is the reason I have to make payment only 56,500 rupees to the vendor. This is the realized gain. This one what we could say is a realized gain. Realized gain. Okay, so for this realized gain, what is the accounting entry? So okay, for the realized gain the accounting entry would be a vendor account is going to debit to bank account, to bank account is going to credit, then to realized gain account is going to debit. Okay, so these are the entries which will get flow okay when it is a realized gain. Remember the accounting entries is the very important one. I'll make this together. Okay, now you can see this accounting entries. Okay, so this is the concept of realized and unrealized. Okay, so if anyone is not clear about the explanation, please let me know so that I will clarify once again. Okay, what is the realized, what is the unrealized? I have explained here with example. Okay, this is the same. It is going to okay happen in real time. Okay, no changes in the real time. Okay, then if anyone is not clear, please let me know the concept. Okay, fine. So I hope the concept is clear for everybody. Okay. Scenario number 4. Okay. Scenario number okay 3 only. Okay, 4. Okay. Now let us move to the configuration. Okay, let us move to the configuration part. SPRO. Financial accounting. General ledger accounting. Periodic processing. Then valuate, then define valuation methods. So the valuation methods, okay, then click on the new entries, the valuation methods, then I will give you is a okay GE that's of GE. Okay, then here select always evaluate option. Okay, means always, okay, whenever we are going to run the foreign currency revaluation, always evaluate. Then document type, the document type, when we are performing the foreign currency revaluation, the system should post some documents. The document type essay I will give. Then select balances valuation. Then exchange rate type, the always the exchange rate type is a em, means on average rate only we are going to perform the foreign currency revaluation. Then determine exchange rate, this is already been selected. Then see, if we are going to select this option, always evaluate option, what it will happen, okay, if we select this option, okay, even the revaluations also taken into consideration. Okay, even what the revaluations what we are going to perform, all it will get considered. Then enter, then save it. T, then enter. Then define valuation areas. The next one is the define valuation areas. Then new entries, the valuation areas you can see here, whether you want to perform valuation at which currency, in which currency. Now you can see we have multiple options, either it's a company code currency, group currency valuation, company code currency, profit center valuation, group currency. It's a depends on the business requirement, we need to select this option. Okay, now click on the new entries, the valuation I will give is a GE. Valuation method doesn't require. Okay, let's see the valuation method GE we have selected. This we need to assign the valuation method. Here the currency is a company code currency. For that company, based on company code currency, we want to perform the foreign currency revaluation. The company code currency is a 10, it's a local currency. Then the next one is a check. Then check assignment of accounting principles to the ledger group. OL is the standard ledger. OL is the standard ledger. Okay. Then whether it is not yet assigned for our accounting. Okay. The accounting principle is not yet assigned. Okay. Now the accounting principle, let us select E. It is not there. Okay. We'll create the new one. Ledger group is the OL. OL is the standard one. Gap and IFRS, NA, Indian Accounting Standards. Okay, we'll give the Indian Accounting Standards. Let's see. An entry already existing with the same key. We'll give any different accounting principle. IFRS. Okay, entries already exist. Okay, fine, no problem. System will calculate, because our intention is that the Indian accounting standards. So the Indian accounting standards we have already specified. Okay, we have created the NA is for Indian accounting standards. Okay, the foreign currency revaluation to be run for the okay Indian accounting standards. Then assign valuation area and accounting principles. Here we can assign. Then new entries, the valuation area what we have defined GE. Then accounting principle, we can assign the accounting principle as a Indian accounting standards. Okay, then enter, then save it. Then now what we have done, we have done the configuration, the necessary configuration, okay, to run the foreign currency revaluation. But now we have to create the GL accounts. Okay, the GL accounts which we are going to create, okay, for GL, for if I want to calculate FC revaluation for general ledger accounting, I must have a separate set of GL accounts. For accounts payable, I must have to have separate set of GL accounts. For accounts receivable, I must have to have a separate set of GL accounts. Then, okay, what we can do, we'll create the GL accounts. Passion FS00 is the transaction code to create the GL accounts. Then the GL accounts, first one is the exchange loss. Exchange loss is the expenses for us. Okay, where I am going to, okay, show. Then GE01 under this company code create. Then this is the expenses. 4 series is the expenses account and it's a PNL account. Here exchange loss. Exchange loss. Okay, exchange loss account. Then control data, select only balances in local currency, then line item display, then here is the 001. Then go to the control data G001, then enter, then save it. So this is the exchange. This one is the exchange loss. Okay, now I want to create an exchange gain. Then create. It's a revenues account. Then exchange gain. Exchange gain account. Then select line item display, then G001, save it. So now we have created exchange gain, exchange loss account. Then the next one which I am going to create is the, okay, valuation loss and valuation gain account. Then so this is the valuation loss account. Okay, I'm going to create with the template because we have already created 90 DA01. Then valuation loss account. Valuation loss account, then other parameters are same. Then I'm going to create the one more GL account. 95 3 series is the valuation gain. Then it's a valuation gain. Valuation loss, valuation gain account. Valuation gain account, save. Okay, what we have done, we have created the valuation loss, valuation gain, okay, and also, okay, then the next one we need to create the one balance sheet adjustment account. Valuation, it's a balance sheet adjustment account. What I will create the GL account. Then it's a balance sheet adjustment account, is a balance sheet account. One series is a balance sheet adjustment account, then it is a liabilities account, remember. Then valuation adjustment, valuation adjustment account, valuation adjustment account. So the valuation adjustment account is a balance sheet account, as I told. Then come to here, only balances in local currency. Then here is the 001. Then this one is the 001. Then save it. Okay, now what we have done, we have created the GL accounts, the necessary GL accounts for account postings. Okay, now let me go to the /n OB09 is the transaction code. OB09 is the transaction code to map the GL accounts for automatic postings. Okay, give the chart of accounts. Then under this chart of accounts, click on the new entries. Click on the now if it is a GL account related, if you have GL accounts related, you can map the GL accounts also. Then click on new entries. Then the GL accounts. Okay, GL account is for sundry creditors. Sundry creditors is a liability. Means when we are, this is for vendors. Okay, remember vendors account. Then then currency is not required. Then loss. Okay, the loss account which I am going to give is the 400, because already existing, for existing batches I have mapped. So that is the reason system automatically it is proposing. This is the exchange rate difference realized. Okay, for realized, these are the GL accounts. For unrealized, then this is the balance sheet adjustment account. Enter, then save it. So this is remember, this account is the reconciliation account where we have assigned into the vendor master data. Okay, on this based on this reconciliation, based on this GL account, the system is going to calculate the foreign currency revaluation. Remember, then click on the next entry. Then next one is would be a sundry debtors. Sundry debtors, this is the reconciliation account. Then the accounts are all are the same. Enter, then save it. Now what we have done, we have mapped the GL accounts for postings. We have mapped the GL accounts for automatic postings. Then so what we have done, we have mapped the necessary GL accounts. This is fine. Now let us maintain the exchange rate. Okay, initially I have told you how to maintain the exchange